Scotts Miracle-Gro, stock ticker SMG, has taken quite a hit over the last year from its high of 176 down to now it's down 53%. They are experiencing a heavy slowdown in their growth due to a severe drop in projected revenue for one of the company's key growth segments. And in their latest earnings call, even though they beat their earnings per share, they still missed revenue and they lowered its full year sales guidance in the US consumer segment due to lower than expected replenishment orders from retail partners. And analysts are expecting the next couple of quarters to be really bad as well. One of the most critical pieces of the company's growth story is its indoor and hydroponic gardening segment of the business, as they call the Hawthorne segment. And obviously this is of great interest to the cannabis industry, since the cannabis industry is a major revenue driver for this side of the business. And over the last couple of years, the Hawthorne segment has grown its revenue at a CAGR of 50%. In the last fiscal year, it was responsible for almost 30% of the revenue. So it is a very significant part of the company's growth story, and obviously it's very alarming when the management's news guidance projected a whopping 40 to 45% drop in sales for the fiscal year in the Hawthorne segment. This, combined with a general slowdown in the cannabis space, is obviously a less clear long-term outlook for the Hawthorne segment. And if we take a look at the valuation, it sits at a 19 PE right now compared to a 5-year average of 20, so it's about fair value in that regard. And for the GAAP PE, it's not able to calculate that due to the EPS being negative in the last quarter. And if we go down to the price per book, it's at 16 compared to normally around 3 over the last 5 years, a 377% increase compared to normal. So this is already looking kind of bleak, I would say. The dividend stats are looking quite okay. Over 3% yield, payout ratio sitting okay. 5-year growth rate also pretty good. Dividend growth rate for 10 years as well. It's looking pretty good in that regard. But if we take a look at the financials, it's starting to look a bit more dim once again. As you can see, the revenue has been rising, but it's starting to drop down again here. And if you go down to the net income, you can also see that it has been growing over the last couple of years, but then suddenly it's become negative. If we look at the cash flow, they also had pretty decent cash flow over the years, pretty solid capital expenditures and a lot of money. But then again, now here we are experiencing negative cash flow. So this is a very bleak outlook, I would say. If we jump into the balance sheet, cash and cash equivalents is very, very low. They don't have much money on hand. And if we scroll down here to inventory, you can see where everything goes, because they are experiencing a massive buildup from $400 million to $1.4 billion. That's a lot of money sitting around doing nothing at all. And if we go down, it starts to look even worse, because you can see down here at the total debt, they are increasing it year over year. Total shares out on filing date appears to be pretty stagnant, so that is at least something good. That was how some of the numbers behind look, but let's take a look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And to do that, we have our 4 main models, where we do have the Graham's revised valuation model. I put an EPS of 4.2 from the guidance, and then I put in obviously the current yield of AAA corporate bonds. I also used the dividend cash flow model, even though it was a negative cash flow. I used the numbers from 2021 and not the latest quarter. And the dividend discount model and the multiples valuation model I did not use in this one. As you can see here, EPS and PE values are all over the place, so I did exclude this one. We can see in the summary that the Graham's model and the dividend discount model are 2 high scoring ones. The discount cash flow model sits around 40, and the average intrinsic value is thus $55. At the current price of $82, we are experiencing an average discount of minus 40%. And if we even apply a margin of safety of 20%, the acceptable buy price becomes $44. So for me, the big takeaway here is that Scotts Miracle-Gro recently cut their guidance again. The key growth segment of the Hawthorne segment has its revenue forecast to decline by 40 to 45%. They have a big problem with inventory surplus and they have trouble selling it. And the company is taking on more and more debt, and they could even go higher. So even at this current price, where it has dropped around 50% due to the high, I still don't think it's a buy. I would apply a big margin of safety for this one at least. So let me know down in the comments if this is a company you are interested in, and if not, I'd love to hear as well. Thank you so much for watching this video, guys, and please don't forget to like and subscribe to the channel.